Just checking the audio. All right, so we are looking at the the difference between CFDs, which are not legally traded in America. So all you gurus out there that show your multiple MT4 screenshots of the same market, you got 50,000 per profit line. Nobody believes that crap, but pretend is fun, right? So for the folks that are outside the U.S., but you want to learn what it is I'm teaching with the futures market, how can you participate? How can you be a player, if you will, in reading price action and learning how to do that? So if we know that I am not going to be trading the CFDs, I won't even push the button on that. Okay, I'm not going to do that. But it's not necessary that I do, because I'm going to show you exactly how to do everything you see me doing with the futures contract. The CFDs, they trade in 24/7. They go around the clock. There's a separation with the settlement price at 4:14 p.m. Eastern time, and then there is the 9:30 opening, and we can see that relatively easy when we're looking at the regular trading hours. So right now I'm looking at the micro E-mini Nasdaq. This is for December's contract, and I'm going to show you the recording. I'm not sure what was going on with the Twitter or X app this morning. I tried to show the recording of me executing this morning and all the business I'm about to show you, but I don't know why it wouldn't let me upload it. So I don't know if I'm on the bad list over there or what, but it'll be part of Caleb's channel upload tonight, so that way you can watch it there. It's going to be a real brief thing, but I kind of like want to outline it here and also show you the same similar things that's shown in a CFD for Nasdaq. So if you're not an American and you can trade through like a Forex broker, I'm not trading Forex anymore. I'm not enticing you to trade Forex. I'm not trying to tell you you should trade that. I'm not telling you should trade the CFDs, but if you can't follow along with the actual futures market, you can get as close as you can, but they're not going to mark to market. And I'll show you what that means in a moment, but they're close enough for you to do studies. Let's say it that way. Okay, so we can all agree that we're just studying price action. I'm not trying to give you trade advice. I'm not trying to give you investment advice, but this is how you bridge the gap between the two. Okay, so that way you're not out like orphans. ICT left us. We're in Forex and he's trading futures, and we don't trade futures anymore. CFDs, you can trade them wherever you're at. If you're not in America, you can probably trade them. Now, there are some countries that are cracking down and making it illegal for people to do it at all. Okay, and I talked about that in Twitter Spaces about a year ago, so you might want to think about that. But the mini contract for Nasdaq, every handle move, that means 4 ticks up or down, it's taking or adding to your account in the amount of $20 US dollars. In a micro, it's $2 for every 4 ticks or one handle. So a handle would be like 20,010 to 20,011. And if you were long one contract, that would be one increase of a handle or 4 ticks or $20. And if it went 4 ticks below your entry in your long, you would be debited mark to market negative $20. For a micro, it's only $2. So it affords the student to focus and study in this medium, not the mini. Okay. And for all of you that are trading in these fund account company things, if you're not using this like I'm showing, you're really doing it wrong, because you're gambling. I don't care who you are. I don't care if that hurts your feelings. You're literally gambling. When my sons did it, they gambled. They were over leveraged. They were trading more than they should have, and the amount of money they give you that could be technically lost is such an infantile amount. It's so minuscule. It's little. And you don't have the skill set. I'm sorry, you don't have the skill set to be consistently able to go up against that as close as you can without going over it, without drawing the account down or blowing it out and then having to pay the reset fees. You can beat these companies. You can beat them consistently, but you have to do it with a shoestring budget approach like trading the micros. And what I'm showing you here today, all of you, in my opinion, all of you can do what I'm about to show you today. That's my personal opinion, and I'm welcome to that. You may not agree with that, but it's my opinion. But before we get into it, let me just quick look at where we're at here. Yeah, okay, we got time. I mentioned on Twitter, I'm going to slow down on Twitter. I just went over there to rabble rouse for a little while. I've had fun. But the tweet I put out this morning, I said that we would likely see a limp opening. That means it's anemic. It doesn't have any kind of real excitement. And it's because we don't see a large gap between where we settled at 4:15 or 4:14 p.m. Eastern time yesterday to where we opened up at 9:30 here today. So if we click on regular trading hours, this candlestick right there, right here, that is the 4:14 p.m. Thursday, September 19th, 2024's settlement price. Now it trades for another 45, 46 more minutes and then closes at 5 o'clock. But this is what you're looking for the opening range gap. If we open, and the next candlestick shows this, 9:30 a.m. today, Friday, September 20th, 2024, that opening price sets the stage for the other parameter for the opening range gap. So since yesterday's settlement price is higher than our opening price today at 9:30, that means we have a discount opening range gap. That means today's opening price at 9:30 is lower than where we closed at 4:14. Now, with CFDs, you don't have this function here. And this is what's caused a great deal of confusion for everyone that doesn't have the ability to trade with futures. So I'm going to show you how to bridge that in a moment, but let me just walk through this real quick. So that way when you watch the video that just streams real quick without any annotation tonight, you know that you've heard it here. And just wait for the closed captions to appear. It takes time for YouTube to put those on. So stop sending me comments and tell me I'm being mean. I'm not being mean, but I'm not typing out a transcript every time I do a video. All right, so here is the first fair value gap between 9:30, technically 9:31, to 10 o'clock. That 9:30 to 10 o'clock is an interval of time that I dub a opening range. So there's two things occurring here. The opening range gap, which is a lower gap opening, which is that candlestick there. And this line, if we were to scroll all the way to the left, which I'm not going to do, would go right back to yesterday's 4:14 p.m. Eastern time settlement price. So it's this line here, that bold line, and this bold line. I'm making it as maximum size as I can. Between those two price points is the opening range gap. Opening range, which is algorithmic, anything less than this, they're making up stuff, let's put it that way. This is the first 30 minutes of trading. Okay, the algorithm's going to use this range for several things. Some of the things I'll teach in 2024 mentorship, some of the things I already mentioned it, but there'll be a lot of things in the book. You do not need to know the things that are going to be in the book. You don't need anything in those books. I've given you enough on this YouTube channel, so it's not a solicit to sell you a book. I don't care if you never buy my books, okay? I don't care if you come back and watch my videos ever again. I'm just telling you, you don't need to buy them, okay? But I want to keep them or keep the concepts private until I put them in book form, because there's so many people out there writing books. As I make videos here and teach new mentorship stuff, they're immediately putting them into print. And to me, it's a little irritating because you're not getting the right instructions. So I want to do it my way, the correct way. And that way, if y'all want to write books after the fact, I could care less then. But the first fair value gap that forms occurs at 934. So it meets the minimum criteria of at least the 931 candle, because you can't use the 930 candle for the initial fair value gap or the first fair value gap presentation between the 9:30 and 10 o'clock. All of these things are still going to hold true if you trade with the US 100 or the US 500 or the US 30. Those are CFDs. CFDs are kind of like a composite derivative type little blend of, because they don't have the access to what the exchanges here do. They just try to mimic it as best they can. And for the most part, it's good enough. Okay, there's traders like Tom Hugard who trades CFDs, and he has his own YouTube channel here. He live streams every single day unless he tells you he's not going to. He trades in the European session and he trades in the New York session sometimes. And if you want to watch someone trade a market that is parallel to the US indices, like the Nasdaq, the Dow, and the S&P, you should watch his channel, because he's actually out there doing it with real money. He's taking trades based on the stuff he's built as a model for himself. So the 934 first fair value gap here, you may have noticed when I was showing the charts on Twitter this morning, or this afternoon rather, and you may have looked at this and said, well, you're doing this wrong. And in the recording, you're going to see it look like this too. What I was doing was, I know that it's not going to show a volume imbalance between these two candlesticks up here, but there is a small one down here. So technically, it should look like this. But during the trade, I wanted to see it like that. Okay, and I'll tell you why. Because I want to see, when we're in consolidation like this, where it's back and forth, what this is. Okay, it's not that it's lacking buying and selling. It doesn't mean that there's nobody's willing to buy. It doesn't mean that there's a balance of buyers or sellers. It has absolutely nothing to do with that. Zero to do with that. This is called time distortion. It's waiting for a specific time. What time is that? It's 9:50 a.m. Okay, so 9:50 a.m. to 10:10. That is a algorithmic window of time where the market will start to spool. That means it's going to run. Okay, so this initial fair value gap, because we opened up, and you should have this in your notes as well, whenever we open up, and if you have a very small opening range gap, well, what is that? Well, it's 20 handles. And that's exactly what we had here today as an opening range gap, because the high of it, which was yesterday's 4:14 Eastern PM session settlement price, was 20,055 for the micro Nasdaq for December contract. And then we opened today for the same market here at 20,035 even. So between those two prices, that's only 20 handles. So that's a really limp or anemic opening gap. It's not a lot to get excited about. Plus, we had a large range day yesterday. So in the morning, it's going to be a little bit more difficult. And then you compound that with a Friday where we've already moved a lot. So it's going to be a whole lot more things that's going to go against you. So you have to really stick to time. And the other time, if it's a lot of volatility, you don't have to require my macro times. I don't require my macro times when there's a lot of volatility. But when there's things that are stacking against you, like we have a small gap opening, it's Friday, we're at the end of the week, and well, that's enough. the small gap and a large range day yesterday already puts the focus on the morning session is going to be a little bit more challenging for someone that doesn't have experience. So what occurs here is when the market opens up at 9:30, it rallies and takes out a short-term buy-side liquidity. So it engages that, knocks out anyone that's already short, so they can't capitalize on that. And it puts traders that would be a buyer above this old higher here, that now they're trapped in it long. So they're going to rake them across the coals to this area of sell side. So their sell stops below here. So they take traders in prematurely by taking out this high there. So now they're thinking it's going to break out and keep going higher. It's not. The market's going to trade. Yesterday's gap did not get traded to the midpoint, and it barely made an attempt to get down into it. So because it's Friday, because it's TGIF, TGIF is a scenario I like to look for the weekly range, whatever the highest high and the lowest low is. And I'll include this information in Caleb's video tonight. Okay, so on his channel, what I'm referring to by TGIF and what that means and how to determine what that looks like on your charts, I'll show you what that is. It only takes me a minute to do that. But it's likely to see a pullback on Friday to 20 to 30% of the weekly range. Not that it needs to do that, but I'm always looking for something like that to unfold. And because we have a low, exciting lack of excitement opening range gap because it's only 20 handles, it's not going to be requiring much, I guess, participation right away. So wait. So what that means to me is I'm looking at that gap here, and I anticipate that they're going to work both sides of it, back and forth, back and forth, back and forth. And I'm going to draw it correctly so that we can see it real quick. That's what it would look like. And I'll get to the breakaway gap in a second. If we know that we have a very small gap opening and we have a Friday, end of the week, and we have a large range day yesterday, we're going to be opening up close to what else? What was the first comment that I was asking you about today on Twitter? Have you extended yesterday's first presentation fair value gap between 9:30 and 10 o'clock? That's what this orange box is here. This orange box is yesterday, Thursday's first fair value gap between 9:30 or 9:31 to 10 o'clock in the morning, Eastern time. The same way this is for today, the first fair value gap. You want to extend them forward, and their life cycle's about 3 days. Now, you're going to find that sometimes they'll still be useful a week, 2 weeks, 3 weeks ago. It hasn't been traded back to. Okay, that's usually how it works. But when we're in an area where it's going to be ranging around it, and notice that when we were close to 9:30, if you look at what the pre-market was doing, because we're looking at electronic hours down here, it's the same thing if you were looking at your CFD. So if you're looking at the US 100, and I'll show you a US 100 chart in a minute. Let me just get through this part here, because I know you're like, I want to see it on a US 100 chart. You will. But let me teach the way I want to teach, please. Some of you are very demanding and very rude in the comment section, and I don't ever see your comment again. So just be mindful of that. I don't mind taking your inquiries and your questions, and I can bring that into the conversations. But when I see you being rude or demanding or entitled, I don't ever get to see your comment ever again. You think I'm going to see it, but I can't. I block you from the channel. Doesn't mean you can't watch my videos or think you're leaving comments. It just means I will never see it. So because we're opening up right here at 9:29 a.m., that's electronic trading hours, you already can guess what the opening price is going to be. It's going to be below where settlement was yesterday up here. That's that price at 20,055. And it's, again, referring to this. That's where trading stopped yesterday. And then it starts here with regular trading hours. But between these two price points, all night long, we've had all kinds of trading back and forth. But when we get close to 9:30, at 9:29, you can see where we're going to be opening in relative terms to the 4:14 p.m. Eastern time settlement price. We're going to be opening higher or lower. And you can guesstimate, really, is it going to be a wide gap? And if it's not a wide gap, I don't like really less than 40 handles. If it's less than 40 handles, I'm using other tools that's going to help me for trading the morning session. Or I'll just opt out and wait till 10 o'clock and I'll trade silver bullet, something like that. So there's very simple rules. You see that? It's not hard. It's not complicated. But you have to have conditions and understand what those conditions are. And the same thing that we're seeing here is applicable to the CFD market. So you don't have to stress about, I don't trade futures, so I don't know how to make this work for me. So because we have a very small gap between those two price points, yesterday's settlement price and 9:30's first opening price tick, that's this candle's opening price. Where is that happening? Well, look at 9:29. look at that candle where it's trading at. Before that candle closes, we're inside yesterday's first presented fair value gap, aren't we? Look at the orange box. The only thing I did here is I took the same gap that formed the very first one on the 1 minute chart. I'm taking it all the way over here because I want you to see it. That's this candlestick right here at 9:38. That's the very first fair value gap on Thursday, September 19th, 2024. You understand? So the only thing I'm doing is taking that gap and I'm toggling on the settings box here. I'll go to settings, and over here where it says style, just click extend right. If I don't extend right, you can see it's just that candlestick right there. But when I click on it like that, it keeps printing it and posting it forward in the future. So that way it's always going to be a reference point for me. So by having that information, you want to know where you are in the last 3 days with the first presented fair value gap between 9:31 and 10 o'clock in the morning, because the algorithm is going to refer back to that again. And all you have to do is look at what price has been doing here. You're going to tell me that's buying and selling pressure, and everybody looks at that first fair value gap. Everybody knew about that? Is that what you're telling me? It's facade. I mean, think about it. These people out here, they talk nonsense. Oh, everybody knew about that. Sam Seiden teaches that. No, he doesn't. He probably will now. Make sure you take good notes, Sam. So if we have the opening here today at 9:30, it's opening inside of yesterday's first presented fair value gap. So what does that mean? It's going to use that fair value gap, not just this one. And the first one that prints in during time distortion may not be all that influential. And it might be useful next week instead. You understand? So we have to look at this orange shaded area because that's yesterday, Thursday's first presentation of a fair value gap between 9:30 and 10 o'clock. That's why I asked on Twitter, I said, have you extended yesterday's or Thursday's first presented fair value gap? Have you made it so it's extending to the right on your chart? Because if you're not doing that, you're going to miss everything that occurs around this day. So when we're looking at opportunities for setups to form, when we're looking for things that build something that's predictable, something that you can forecast, something that you can anticipate and not be reacting. People that do not know how price books, people that don't know how these markets work, are always going to be reacting. If you're reacting to something, that means you didn't anticipate it. That means you didn't know it was going to happen. And that means you're not informed. And that means you're not smart money. Now, what I teach are concepts to help you predict. You absolutely are predicting the market. You are predicting it. Anyone that tells you you're not is talking out their ass. They have no idea what they're doing. And what they're doing is they're making allowances for themselves because they're not good at doing it. So they have a wide array of excuses. It comforts them because they're not going to be holding themselves to the degree of accountability that other people in the industry, like myself and my students, if we're challenged, can you do this? We're right there at the front of the line. Yes, let me give you an opportunity to see it for real. Let me show you what you don't know. Because we know what we know, and nobody's going to tell us it ain't happening. And we can do it in our own hands, and we're doing it better than any other school of thought out there, more consistently. And you can learn this. You can learn how to do this. You don't just watch me do it. You have to go in the charts and practice. But you have to start with these reference points. And you see by journaling them in the last 3 days, did the first presented fair value gap 2 days ago, did it have any influence on the price today? These are questions you should go in there and looking for. And you're going to be discovering that, wow, that was amazing how that was just perfectly offered as a setup. And it had very little drawdown and it fired away, bang, 30 to 50 handles, if not more. But you're all struggling looking for setups. and they're right in front of you. If you just listen, I'm telling you how to find them. So today, what I was doing is I was watching this initial fair value gap and anticipating this back and forth time distortion where it's just going to be working what? What is it working? Well, we ran the initial level of buy side that was over here that was pre-session. So when we wicked above that over there, it went back down in, and what is it hitting? Today's opening price. What is the opening price at 9:30? It's the low of the opening range gap. So watch what it's doing. It's opening here. It swings up to the high, which is yesterday's 414 settlement price. That's the high of the opening range gap for today. Then it trades through that to get liquidity over here. And then it trades back down, overlaps the low or the opening price. And then what does it do again? It one more time reaches more buy side that maybe didn't get hit here. They're going one more pass in. And they're dropping it down again. Where's it going? Right down to the opening range gap low. If you're just looking at this, okay, or you're a dingleberry and you are out there trying to point to where fair value gaps don't work and look at this, they get ran through. It's designed to do that. It's designed to do that because you don't know what the fuck you're talking about. There's logic behind these things and you don't know what it is simply because you can draw a rectangle in one candlestick that is not bridged with the previous candle or the subsequent next candle doesn't make it a fair value gap. It makes no sense for anybody out there to assume just because you think you see it there, it doesn't make it a fair value gap. Just like every down closed candle is not a bullish order block, and every up candle is not a bearish order block. So it's a little frustrating. The teacher in me gets frustrated because I know that what these people are doing is they copped out. They didn't want to go through the process of really learning how to do it. So it's easier for them to poke fun and say, look, it failed here. But I'm murdering these markets. I'm doing it in front of people and my students are doing it. And you can be one of them. And you don't have to like me as a person. I don't care. We're not here to be friends. But I want you all to do well. And if you understand that this is what this is going to do because of the day, it's Friday, we have a very small gap opening and we had a large range yesterday. So the morning session is already going to be what? More complicated and challenging for a new trader. It doesn't mean you can't trade it. It just means that when I talk in two schools of thought. My students that understand how to trade, the ones that have their model and they don't need to listen to me, okay? They're more advanced. Or the people that are just coming to me, they don't know anything. When I say don't trade on Mondays most of the time, it's because I don't want that new student to trade on Mondays because they tend to be a little bit more demanding in experience. When I say don't trade on high news events, it doesn't mean you can't trade on them if you know what you're doing. You just got to wait until after the report hits. Then go in and look for the inefficiencies or the liquidity that's left. But if you don't know what you're doing, if you don't even know what an economic calendar is, you can get out there and get hurt really bad. And I don't want any of that to happen to any of you. So because we have all those factors today, that first gap is really of no importance yet because it still has to worry about yesterday's first fair value gap because we opened inside of it. This is a small little gap. This is a much larger gap. And we have been using it since yesterday over and over and over again. There were many trades over the London session, the European session, Asia's close overnight last night in Asia. There was trades around this orange box. They're there all the time. And you've never noticed them because they've never been in any of your retail books. That's why you didn't see them. Because if someone says, hey, look, ICT just rebranded something, they should see these setups and they should be there before 1996. They should be there before 2016 for sure. And they aren't. Okay, so forget about it. So in here, once we got to, here's 950. Okay, that's this candlestick right there, 950. Now we're at the time. We're at the time when the market will do what? Spool. Now think about what has transpired. We had a nice up close week. We've had the market open with a small opening range gap, 20 handles. We opened in yesterday's first presented fair value gap. This gap here is going to be the least important. We ran back and forth over top of the opening range gap. And yesterday's opening range gap did not even trade to its midpoint or consequent encroachment. It barely made its way towards the upper quadrant. So there's a huge discount or a vacuum of price where there was no buying and selling because it never went down into its gap yesterday at much. So because it's Friday and TGIF is, thank God it's Friday, meaning that it's likely to have a 20 to 30% retracement of what the total weekly range was. So there's a lot of things that could be built into expecting the market to work down below yesterday's first presented fair value gap. But you have to wait until the algorithm, not the buying and selling pressure kicking in, it's the algorithm. Okay, it's the price engine that's going to start offering lower prices, and it matters not how many people you see on a depth of market or level 2. Market makers don't use that shit because what you're talking about, you're talking about a dealer. You're not making a market if as a dealer. You're trading in the same price feed that everybody else is. You're not making that price. That price is what's out there right now, and you aren't delivering it. You're not doing that. It's way above you. You have no idea what the hell's going on. And by understanding that these things are electronically driven and they're algorithmic, that means, yes, there's going to be reflected time in sales that says there was buyers at this price and there were sellers at this price. And this was the amount of traded contracts there. But that's not going to have any lasting directional influence. It might be a couple ticks here and there that it jumps to get those orders, but it's going to go lower because it's driven to go lower. It's scripted. And that's the part that most of you are struggling with. I understand. It's a little scary when you think about it because we don't have a free market then. We don't have a free market. And I'm glad we don't have a free market because that's what makes it advantageous. That's why I can time this stuff. That's why I can explain it and make a concept around it because it's scripted. You know what's going to likely occur unless there's manual intervention. So if there's things that are scripted, wouldn't it make sense that they're going to repeat the same times of day? Yes, absolutely. Every top of the hour, first, I'm sorry, yeah, 10 minutes before you get to the top of the hour, that's, in this case here, it's 9:50 a.m. and they last for 20 minutes. So in that 20-minute interval, what we're looking for is, okay, now think, it's Friday, we have a small gap, we have a large range, and we've already taken buy side here. So, and we open inside of yesterday's first presented fair value gap. Me getting to the point is this. It's more likely that it's going to spool at 9:50 to 10:10 lower. Lower. So if that's the case, if you're telling me that we're looking for yesterday's larger gap that didn't get traded too much because we have a very anemic small gap here today, well, simply just be aware of those levels, but focus on yesterday's gap. Because there's more opportunity for the market to want to go down into that area because it's going to offer efficient delivery. Buying and selling is not pushing price. It doesn't matter how much buying and selling is occurring. If the market's going lower, it's going lower because it's going there, because it's driven there. Not by the selling, not because there's a lack of buyers. It's simply being taken there because it's coded to do that. And yes, you'll see all as the transactions come in, because people are sentiment driven animals, okay? We're greedy, we're scared, we're fearful, we're impulsive. So naturally, yes, we can look in all these candlesticks, and smart people with hindsight can say, look at this, ICT's talking nonsense, because all you have to do is look at the volume profile, and all you have to do is look at the time in sales, and all you have to do is look at level 2. You need that bullshit. After it has happened, you're looking at that. You're justifying something after that's happened. In the depth of market, those ladders that show you supposedly where, like, there's this many buyers waiting above here at this price, or this many sellers waiting here. They're not all real orders. They're not all real orders. So it's a spoofing. There's been large institutions that got themselves in trouble doing that very thing. So why would you look at something where they're dangling carrots when those carrots really aren't there. It's a mirage. But see, I know what I'm looking for, and I don't need a book map. I don't need those instruments out there that tell you supposedly a pseudo amount of contracts that are resting at a specific price level above or below the market price. You don't need those things. You don't need them. But I would have loved having it in the beginning because I didn't understand the concept of liquidity. But when you understand liquidity, you're going to get confused by looking at those tools only and not understanding what the algorithm is doing. Just simply because there's a lot of orders above the market doesn't mean it's going to go up. All you have to do is study it. At any given time, any day, you'll see that there's a large pool of orders that just simply aren't going to get traded to. And you're thinking, okay, well, they're not interested. Who's they? When you talk like that, who is the they? But when I say the they, you all get a case of the ass like, this guy's a conspiracy nut. But there's an algorithm that delivers price. And if you can time when to anticipate the market reacting a specific way, the condition is this, the narrative is this, it's going to go lower. When I tweeted this morning, I said, focus on 2 sell side liquidity pools. Does that sound bullish to you? That means something below the market. So again, the direction was right. There's a short-term low there. There's a short-term low right there. There's a short-term low right there. There's a short-term low right there. And there's a short-term low right there. Okay. I used the easiest one that would be below here. So that's this one here. This one I'm not too concerned about. I ain't worried about the fair value gap because if we're going to get down here, it's going to want to go below these relative equal lows. So from up here at 950, I'm anticipating the market at that time, it's going to start moving in that direction. That's what a macro is. A macro is a small list of directives that this program, because that's all it is, it starts processing and delivering on the basis of how fast it's told to do it, how many times it has to stop and create this scenario here, which is time distortion. You are all told that it's chop or it's consolidation or it's indecisiveness. It knows exactly what it's doing, folks. it knows exactly what it's doing. It has a list of directions and it's following it. That's all it does. Okay. And this engine that delivers and manipulates price, we all are watching a video game. And we have no control with our buying and selling. If we had that much influence because of our buying and selling, we could crash the market. We could send it to the moon any given day. We could do that. There's enough people in the world that can happen. Think. But when there is a perfect opportunity to screw people over, they will manually intervene. And that's how you get the GameStop and the BlackBerry and the AMC theaters. Reddit, they got together and they said, look, we're gonna screw all the hedge funds. Well, the hedge funds, they aren't controlling price. They're just big players in it. But they don't know what they're doing. They're just in there gambling with large pockets, deep pockets. But when you have the ability to control price, and you say, okay, there's a whole bunch of suckers out there reading Reddit, and they're all going to start piling in and buying it up. Okay, wonderful. They'll buy too because they're greedy. They, the hand. And what they'll do is they'll offer big, huge skips in pricing where the price is gapping up like crazy because they know that there's going to be a fevered pitch to do what? Buy it. It's going to keep going up. It's going to keep going up. And the more people on Reddit, the more people on Twitter, the more people on Instagram that were talking about those stocks, which I said, don't touch them. Don't touch them. That's a Ponzi. The market makers were literally building in a premium. They were just literally offering higher, 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 and they were getting traded at. That's the same principle here. It's just being slowed down to a manner where it doesn't look like except for normal price delivery. It's not shocking. It's not jarring. Now, there's the days like with OMC, there's non-farm payroll, CPI, PPI. Those types of news drivers are the same event that you've seen happen in AMC, BlackBerry, um, and GameStop. That's the same thing. That's the same thing that happened with Bitcoin. That's all that you watch that happen like that. That's how I timed it when I told you years ago. I said it ain't going to go to 20,000. It's going to go to 6,000. It's going to go to 3,000, and I was right. And then I said I'll tell you when it's going to go to 20,000, and I did. And then I told you when it's going to go to 30 and 60, and right when we got to 70,000, I said we're done. And then it traded lower. Yes, there's a meme out there where I said it's going to go to $100 because I ultimately know it's going to be worthless later on. But right now, it's a wonderful little Ponzi for people to get cooked in. But the market is slowing that Ponzi scheme down where it is allowing people to go into these markets and provide liquidity for people that use them professionally. There's always going to be somebody out here trading, and it only takes one contract to trade and make that price book on your chart. But that's not buying and selling pressure. For instance, let me suspend your disbelief for a second, okay, just for the sake of having a conversation here. Because if you don't give me this, you might as well just turn the video off. Let's just say, for the sake of argument, that at 9:50 to 10:10, some artificial intelligence starts a program and it starts offering lower prices. And it doesn't matter how many people come in to buy it. It's just going to keep going lower, offering lower prices, lower prices. What do you think that does? Well, for people that want to buy it, they're thinking, wow, that's cheaper now. Let me buy it. Oh, wow, it's down at this support level. Let me buy it. Oh, it's at this old high. Let me buy it. Oh, it went below here. So we're going to do some of those real tricks where you can buy sell stops, because that's what crafty traders do. Well, and it just keeps going lower. And it keeps going lower below that. What about the support that was supposed to be here? It just keeps going lower. So who's right? What school of thought's right here? Mine. This algorithm is repricing. That's all it's doing. But what happens is the people that know this is occurring, the people that learn from me, the people are out there actually using it too, outside of my own hands and influence now because they learned it, they can be short in this move. And they can profit without any worry about being a pattern, an old archaic methodology, no Wyckoff, no Sam Seiden stuff, no Gann, no Elliott wave, none of that stuff, no Hurst cycles, none of that stuff. It's simply understanding time, there you go, and price. Price is going to behave like this. It's going to start rebooking and delivering to sell side. That's time and price theory, ICT style. We're not doing diagonal trend lines. We're not doing geometry and all kinds of pattern stuff. And it's nonsense. That's a religion. That's all religious thought process. When you're looking at price patterns and you think that this is somehow having an influence, it has an influence over people buying and selling. But that buying and selling that these people are doing has absolutely no bearing on what these artificially delivered markets are doing. So how can we capitalize on that? Well, if you're inside this opening range between 9:30 and 10 o'clock, the time for it to start going lower is now at hand at 9:50. Now we want to see it trade lower. I want to see it go through today's fair value gap because it's time to do so. We've already trapped traders up here. So now it's going to attack what? This pool of liquidity right there that hasn't been traded to yet. Let me take these vertical lines off because I don't want you thinking they're candlestick wicks or anything. This is some good shit, I know. I wish I would have known this when I first started. So right below here, we're targeting that. We're targeting that because there's going to be what's resting below there? Sell stops. Somebody went long there. And that's all the algorithm needs to know is there was a low here. So it's going to keep dropping down until it gets to here. Oh, there's a lot of buyers. It's real cheap. Doesn't matter. It's going to keep going lower because it knows its list of directives. That's what a macro is. It's a short little program script that it starts doing something specifically. And what it's specifically doing is going to the liquidity pools that I'm telling you it's going to go to. Now I'll let you figure out how that works. So when it drops here and here, and then the relative equal lows over here, right there, we can now anticipate that once we get through the bottom of this fair value gap, I've already removed my interest in it. I just want to see it trade below it. If it were to trade back up to it and bump it like an inversion fair value gap, all the better, fine. But because of this day being manipulated like it is, because of all the factors, Friday, small opening range gap, large range yesterday, so many things, and we open inside of yesterday's first presented fair value gap, that's a huge list of things that I need this to start moving in my favor. I'm not a breakout trader. You'll see clearly where I'm getting in it. I'm not breaking out to the downside and going short based on that. Because I didn't want my gap shown like this, I wanted to take away that volume imbalance, which is this candlestick's close and this candlestick's open. I'm going to take that away and put it just on the wick like that. So now I'm showing this candlestick's low, this candlestick's high, and I'm ignoring this volume imbalance because it's the least impactful or important thing, because this gap, the first presented fair value gap from yesterday, we opened in it. So it's been using it. So the algorithm's tipping its hand saying, this is the level I'm working with. It's the high of it, the upper quadrant, the middle, the lower quadrant, and the low. They're very specific prices. It's not a zone. When we're bearish, we want to see it not go back in the upper half once it goes down. What does that look like? Well, because I'm not looking at the volume imbalance here, I can then see this as a breakaway gap, which is what you'll see in the video where I'll annotate it. Okay, I'll show you that this is what I'm viewing this as, a breakaway gap, meaning that because it's the time of the market wanting to rebook and price lower, and it doesn't have any effect on the buying and selling influence. There's no influence by buyers and sellers causing that. It's just artificially being delivered lower to take liquidity in here. What liquidity is in this area here? Nobody's actively going in and placing big bets there, but there absolutely was orders resting above this high, which they've already worked there. So what's the opposing liquidity? If this is the buy side that was taken, where's the nearest obvious sell side liquidity pool? Right there at that low. So the algorithm doesn't know how many contracts there are. It doesn't know. It doesn't need to know that. It just knows that that low hasn't been traded to. So let's start driving lower. And the macro is this. It looks back through the previous session. That's all it's doing, folks. It's very simple. It's going back through the previous session overnight, yesterday afternoon, this morning, London, Asia. It's just cycling back through the previous session. That's all these things are doing. And it's easy. It cannot hide it from you. I don't know why you guys are fighting it. You're arm wrestling me because you want to hold on to your little bullshit concepts, retail horseshit. Every retail trader is looking for something in here. Moving average crossover, some kind of bullshit, golden cross. That's dumb. It's stupid. You have no advantage in that. You have every reason to get into a trade and believe this is why you have made that decision, but that decision has no bearing on why the price is going to go up or down. I'm telling you what it's doing. This gap here tells me that I'm absolutely seeing what I expect to see, which is it's going to drive down to here. So once we enter with this candlestick here, inside this orange box here, that's yesterday's first presented fair value gap between 9:30 and 10 o'clock. Once it trades down like this, I'm waiting for it to come right back up and get the high of it. So essentially, what am I doing? I'm selling short when the market's going up on an uptick. That's what high frequency trading algorithms do. That's what smart money does. That's what large fund traders do. They cannot sell short on a downtick. They have to wait for an uptick. Some of them have filters where they have to wait for price to move up for a certain threshold, and then they can start going in and selling short, or dropping down for a certain measure of time or a percentage before they can start buying. But you're not privy to all that stuff because it ain't in your books, okay? But that's the real stuff. That's the real things that go on. So if we can anticipate the market trading in this candlestick here, when it goes up into the high, I have an opportunity to do it there, or I have an opportunity to do it right there. And then what happens? It breaks lower and trades to the middle or consequent encroachment of that shaded orange area. That's yesterday's first presented fair value gap. Once it does this, it gives you a breakaway gap, it runs into it, gives an opportunity to trade to the top of it, and then goes to the mid part or consequent encroachment of it, middle, and goes down below it. It should never, listen, okay, this is never, ever, ever repeated anywhere else. You can say it is, but find it in a book and get your money because nobody's able to do it. Just talking about what it looks like ain't what it is. This candlestick here, we go right up and hits the middle or consequent encroachment, and then we leave that previous day's first presented fair value gap. So now watch. Here's that candlestick right here. We trade into it and hit consequent encroachment of yesterday's first presented fair value gap. The next candle, look where my entry is. You see that? Watch. Watch when I hover top of it. See it? It's at the high of yesterday's first fair value gap. It's random, right? But ICT, why didn't you trade in the fair value gap? Why didn't you do something else? Because I know what I'm doing. I know what I'm looking for. Okay, so I'm entering at the high of that gap, and then I know I'm really on side because I have the breakaway gap. I'm in time, the time of the market being delivered algorithmically. I know that everything is in my favor, that this is going to go lower. Contrast that with, I hope my harmonic pattern here, I hope my rabid platypus fucking pattern, okay? I hope that it's my moving averages don't get pierced through. I hope my overbought stochastics or divergence is going to be profitable this time. You're worrying about things that you can't control. I am believing something that I know controls price. Who has the greater faith? Why do you think I talk the way I talk? It sounds arrogant, doesn't it? It sounds egotistical, narcissistic. That's all the descriptive adjectives that people place on me. And you know what that means? I'm being complimented. That's how I take it. Because you see something in me and my students because we are doers. We are not talkers. We are fucking doers. We know exactly what we're looking for. We're calm, we're collected and cool. But when some joker comes stepping up here and talking some nonsense about retail this and retail that, or something's better, something that, please come. Come and get your ass sorted. Let's go. Because I will show you you know nothing. And I'll be polite about it. I'll be polite about it. Because I know if you see it and you taste it, you're convinced. And you're going to be wanting to know how the hell I did it. How the hell did he do that? How the hell does he know that stuff? Right. It's in my YouTube channel. It's in long discussions like this video here. It's in your eyes, you're thinking it's taking too much time. It's taking so much time. But I'm teaching you. I'm showing you this is what you're supposed to be looking for. Because if there is an algorithm, it's going to do these things every single day. Every single day, it's going to repeat these same types of things. Getting short here, then it trades down. It does not take the relative equal lows out yet on this drop down here. But what does it do? It trades all the way back up to some random level. It's the low of yesterday's first presented fair value gap. That candlestick hitting it. It's the first candlestick it touches it. Because I'm marketing in, you can see this. I have to do the market order because I have people believing that it's market replay. And you can't use the upper left-hand corner buttons for the buying and selling on market replay because they're down somewhere over here. So I do it that way. I could have very, very precise entries if I'm using limit orders. And I will be doing limit orders in this mentorship. So that way you can see how to get really good, tight entries. So that way your stops can be a little bit more meaningful in terms of managing the risk. So I'll teach you how to be more precise about your entries. But Caleb doesn't need to know that yet. He just needs to know how to engage price and see what it's like to get in and watch what price does afterwards. So getting in there, and then ultimately it trades back down and goes to that. See that little tick right here? That's below the relative equal lows over here. So entering here at the top of yesterday's fair value gap and getting out at the low underneath the relative equal lows I gave you on Twitter. That's not market replay, folks. Okay. This is all the really real shit. Okay. Just because I'm teaching in a demo or a paper trading account for my own personal protection, because I'm not licensed to give trade advice, all I'm talking to you about is how I know these candlesticks are going to do certain things. I am not promising that it's going to make you money. I can't do that. I can't promise that you're going to get rich. I can't. But I can promise you that you're going to learn how to read these candlesticks better than anybody else can teach you. And some of my students have gotten really good at it, and they said, I'm going to make my own decision. And these are for the people that left this comment. How do you know when to trade with real money? You'll know. I'm never going to tell you you're ready to trade with real money. You're going to know because you're so bored of doing it in paper and it's so consistent. The natural progression is going to be you're going to try and see what happens. And I never tell you to do that. But when you feel like you're going to do it and you don't even need to ask somebody else's opinion, then that's when you're going to be ready. But unfortunately, people see a video or they watch a group of people trading and they get caught up in the frenzy of them being right once in a while. And that's unfortunately what happens when you watch these influencers that are live streaming. They have affiliate links at the bottom, and not all of them are assholes, but they all do have this same characteristic. They're out there putting it in front of you. And you, because you have selective sight, selective hearing, much like trolls, they don't see the proof that I'm providing. They don't see all the profitable students. They don't see it. They don't want to see it. The people that watch these other live streamers, and when they get it right, they think, wow, if I would have did that, I could have made that money today. And then what they do is they pay for the affiliate link to get a funded account challenge, and they go in, they follow the same person tomorrow. And the luck that they had the previous day, because that's 99% of what you're seeing, they fail in front of you and you copy them. You don't have any idea why they took the trade, but you're waiting for that feel good, warm and fuzzy. See, I don't do that. I'm teaching you how to do this on your own because no one's going to tell me that I haven't created profitable students because it's all over the place. And once you are a profitable student, no one's going to tell you what you've learned is made up, contrived nonsense, make believe. Okay. They're going to give you every excuse, but you're the one making money. You're the one that stops your job and you stay home and you live a life that's different. And they're going to be hating you. Any chance that they can have to say something negative, at that time, who cares what they say? But in the beginning, you have to just weigh it out. Who's doing what? I'm teaching you for free. There's no obligation for you to come back to my YouTube channel. There's zero obligation. But I keep producing, don't I? And you can't get away from me because now the bug has bit you. And when you taste and see this stuff happen in your own hands, it's over for you. You'll never want to look at the market any other way, and you're going to want to learn more, and then you become addicted to it. And you can't be an addict without ICT in the name. You're one of the brood. And that's unfortunately on the outside looks like a cult, but I don't have any control over you. I'm giving you the freedom. I'm giving you the freedom to have an independent thought process that allows you to make your future whatever you want it to be. And that's exciting. So anyway, I did a lot of trail stop losses for the purposes of showing Caleb. And where I place the stop would be based on what his expectation would be in terms of placing a stop loss. And you'll see that in the video, but that's what this is here. That's being stopped out. And then that's being stopped out. And then I went back in. This is not something for him. This is just me, because I knew I was going to talk about this today with y'all. It's just me twisting the knife. So over here, if you look at this candlestick right there, this long, lowest candlestick, let me get it out of the view of my little watermark here. This candlestick right here is the lowest of all the lows in here before we see this drop down. Can you agree with that? This one here is not being factored yet, not for my decision. While I'm watching the candlesticks over here, I'm looking at that one. So what I'm seeing is this. I'm measuring the body down to the low. Okay. If you ever see my charts have one single line and it just looks like it's floating out there around nothing, this is anchored to nothing that makes any sense. If you look back at my old recordings, even stuff on baby pips, you'll see me anchoring there, and that's the consequent encroachment of this discount wick. If I'm bearish, I can enter at that price. See that tick right here? Watch. See that? What's the price of the consequent encroachment of that wick right there? 19,974.25. Tell me, who is daddy? You're damn right it's Poppy ICT. It's Poppy ICT, baby! It's repeating phenomena of precision. Perfect. It's perfect. Getting at the high of yesterday's fair value gap that nobody would have been looking at it. Chris Laurie would have been talking about that yesterday and into today. Nope, wouldn't have happened. Wyckoff wouldn't have done it. Nobody. Getting out below the short-term low. Relative equal lows over here. There. But now here, I know that we're going to dig a little bit deeper. So this level here, let's scroll on over here and find out what that mystery is. I know you love it, don't you? Man, I can't wait to trade this way. I know. What do you think this is? That looks random, doesn't it? All this is the same thing. It's the consequent encroachment of that discount wick. But now I'm going to treat that as a target. So now, what is that price? 930.50. So I need that price or lower. And there's my exit right there. It slipped a little bit. 19,930.75. So that's not bad. It's pretty close, right? Close enough for government work, right? But all this drop here, I don't need that. You don't need that either. And then what does it do? It starts to rally right back up. So all these things drawing right back up into yesterday's first presented fair value gap. Drops, rallies back up. What's it working? Yesterday's fair value gap. But now, late in the day, we're returning to first fair value gap. That's true value on the daily range. Your first presented fair value gap between 9:30 and 10 o'clock, you need to know what that is because the algorithm is going to refer back to it. Unless it's a trending day, it's going to refer back to it. I have done so many trades without pointing this to you, but if you go back and look at them, you're going to see that this is a lot of what I'm doing. And again, because I never intended to teach it to you. And you can be mad at me and say I'm an asshole, you're a dick, you should have taught this sooner. Just be thankful that I am. Just be appreciative that my son is encouraging me to do this because none of you could have encouraged me enough to do it. I never wanted to do it. But he just said, look, just let him see it. So you're seeing it. So anyway, that's the business on that. Now, real quick, let's get in through the US 100. The gap here, 414 previous day and 930 opening price. We don't have the what is it? US 100. And I'm just going to use this one. I'm not saying that that's a good broker. I'm not saying that you should trade through them. I'm just saying that this is something that you need to determine on your own. And if you do what I'm showing you here, you should be able to track price as close as you can without using the actual futures market. So if we pull that up like this, you can already see that I have the opening price at 930. There's the opening price at 930. And this settlement price here is yesterday's same 414 closing. So when we get to the candlestick at 414 yesterday, that's this candlestick right there at 414, the closing price. So while we don't have the break in trading between 4:15 to 6 o'clock restart, and we don't have the break from 4:15 yesterday to 9:30 in the morning in the CFD market, which is what this is, it is not necessary. All you have to do is know the same price points, and you'll have the same information here. Now the gap, the first gap, for today, there is a volume imbalance here, and there's a volume imbalance here. Two schools of thought here. If you are using a CFD, always include your volume imbalances. Always. Don't do what I did today, because that's just experience. Always include them. That's why I teach. If you see a fair value gap, always include the volume imbalance because of CFD and futures. I'm sorry, Forex pairs. Your brokers are going to screw you, and that's just the truth. And you're going to have different pricing. So if you don't include the volume imbalances, you're not going to have a true depiction of what you should be focusing on. So you can see here with the volume imbalances included, and that means that this candle is closed, the body's top to the next candle's open. That little separation, that's the volume imbalance. Just like this separation between this candlestick's close, or the high part of the body, not the wick, and then the opening of this candlestick. There's a small, look at it like this. You see that separation between the two bodies there, and the separation right here? That's my volume imbalance. That's not in any other books, okay? That's you seeing what the algorithm will refer back to. The market here at 950, that's the macro time. 951, start going lower, targeting sell side, targeting relative equal lows over here. Same stuff happened over here. Ain't this a wick that I just talked about on the futures contract? Midpoint of that wick, get short there, and it drops. Everything's the same, okay? So if you're trading with CFDs, all you have to do is use the times, because that's the most important thing. The times I'm telling you at specific price points, because it's first the time, and then what price around that time. If you do the same things I'm showing you here within the CFD markets, and the same thing is for US 30 if you want to trade the Dow, if you want to trade the US 500, that's the equivalent to the S&P market, just in a CFD format. The same thing. It's the same stuff, folks. You're just not seeing the same price because clearly they're not going to agree. But that's all I wanted to show you today because my battery is warning me that I'm getting ready to see my laptop shut down, and I used that as my timer. So I was going to go as long as I could. And we came all the way back up to here and cleared out the high of the day. So hopefully you found this somewhat insightful. Hopefully you can calm down a little bit if you're a CFD trader and you're still in the Forex world. You can do everything that I'm doing here with reading price in that CFD. You just need to know how to navigate your chart. That's all. And it's all we showed here today. And we will be back at it again next week. And I'm going to have homework for you every single night. So it's going to feel like university all over again. Enjoy your weekend. I'm going to have a Twitter space tomorrow. It'll probably be a real short one. And just bring some road snacks. And enjoy your weekend. And I'll talk to you tomorrow, Lord willing.